$31 trillion is riding on a single promise that artificial intelligence will change everything. A few weeks ago, one man quietly put almost his whole fund on the opposite bet, that it's a lie. He's been right before. The last time he bet this big, they called him crazy, right up until the market collapsed and he walked away rich. So what does he see that the cheering crowd doesn't? Why did a stock market on the other side of the planet freeze in the middle of the trading day, like someone pulled a fire alarm? And why is the smart money suddenly, quietly, heading for the exits? Because in every con ever run, the people on the inside leave before the marks even know the game is over. Watch what the money does, not what it says. So look at the money. The man is a hedge fund manager named Michael Burry. If that name sounds familiar, it should. He's the one who saw the 2008 housing crash coming when almost nobody else did, bet a fortune that it would happen, and cleaned up when the whole thing fell apart. They made a movie about him. And at the end of June 2026, he showed his hand again. According to what he disclosed, roughly 80% of his fund is now sitting in something called put options. Here's what a put option is, in plain terms. A put is a bet that a price is going to fall. You're not buying a stock hoping it goes up. You're placing a wager that pays you when it goes down. So when someone puts 80% of their money into puts, they're not nervous. They're not hedging their bets a little. They are betting the house that a crash is coming. And the names he's betting against are the exact same names everyone else is in love with right now. The big chip makers, the AI darlings, the companies whose stock charts look like a rocket taking off. He's reportedly warned the whole thing could drop around 30%. So the first question stands. What does he see that the crowd doesn't? To answer that, you have to understand what a bubble actually is, because bubble is one of those words people throw around without really knowing the machinery underneath it. And the machinery is old, much older than AI, older than the internet. It's the oldest trick in the book, and it has a shape you can draw on a piece of paper. An economist named Jean-Paul Rodrigue at Hofstra University mapped that shape out, and once you've seen it, you can't unsee it. He broke every bubble into 4 phases, and they always go in the same order. First comes the stealth phase. This is where the smart money, the insiders, the people who see it early, quietly move in while the thing is still cheap and nobody's paying attention. Then comes the awareness phase, where the rest of the professionals notice, and the price starts climbing, and it looks like a smart, healthy trend. Then comes the mania phase. This is the loud part. This is when your neighbor won't shut up about it, when the news won't stop covering it, when people who have never invested in anything are suddenly certain this is the sure thing that will make them rich. And in the mania phase, here's the key. The price is no longer connected to what the thing is actually worth. It's only going up because people believe it will keep going up. And then comes the last phase, the blow-off. The moment the buyers run out, and the whole thing falls off a cliff. Now think about where things stand with AI. Think about how you can't open a phone, watch a show, or sit in a meeting without someone telling you AI is about to change your entire life. Does that feel like the quiet stealth phase to you? Or does it feel like the loud part? But here's where it gets darker, and this is the part the cheering crowd never wants to hear. The reason bubbles keep happening, over and over, for 400 years, isn't that people are stupid. It's that the calm before the crash feels exactly like safety. There was an economist named Hyman Minsky who spent his life on this, and he's the one who nailed the cruelest twist of the whole thing. Minsky's idea, in plain words, was this: stability creates instability. When times are good for long enough, everybody relaxes. Lenders get sloppy and hand out money to anyone. Investors forget that prices can fall. Everyone takes on more and more risk because nothing bad has happened in years, so why would it start now? And that comfort, that exact feeling of this is safe, this always works, is what builds the pile of dynamite. The market feels safest right before it breaks. There's even a name for the moment it snaps. They call it a Minsky moment. The instant the confidence cracks, and everyone tries to run for the same door at once. And that brings you to the fire alarm. Because a few weeks ago, on the other side of the planet, one of those doors got jammed. In late June 2026, the stock market in South Korea took a violent drop. 2 of its biggest companies, the giant chip makers Samsung and SK Hynix, the ones whose memory chips power the whole AI machine, fell so hard, so fast, that the market itself hit an emergency brake. Yes, that's a real thing. When prices fall too fast, A stock exchange can automatically freeze all trading for a few minutes to stop the panic from feeding on itself. It's the financial version of pulling a fire alarm and locking the doors so the crowd doesn't trample itself on the way out. And it happened. In the middle of the trading day. On the companies sitting right at the heart of the AI story. That's not the sound of a healthy market. That's the sound of the door getting crowded. So go back further, because none of this is new. It just wears new clothes each time. A man named Charles Kindleberger, an economic historian at MIT, wrote what a lot of people consider the Bible of this stuff, a book called Manias, Panics, and Crashes. And what he found, digging through 4 centuries of financial disasters, is that they all rhyme. There's always a new, exciting story, a railroad, a radio, an internet, a new invention that really is going to change the world. And because the story is partly true, people lose their heads over it. They stop asking what a thing is worth and start asking only how fast it's going up. Kindleberger showed the same movie has been playing since the 1600s, when Dutch merchants bid the price of a single tulip bulb up to the cost of a house, and then watched it collapse to nothing. A flower. People traded farms and life savings for a flower because everyone around them was doing it and getting rich, and stopping to ask, wait, it's a flower, felt like being the only fool in the room. That feeling, the fear of being the one who missed it, is the engine. It has never once changed. Only the flower changes. That's the pattern. So now, is AI a con? Here's the honest, uncomfortable answer, and it's the whole trick of how these things work. The technology is real. The internet was real too. Railroads were real. That's exactly why the bubble grows so big, because there's a true story at the center of it that makes the lie easy to swallow. The con isn't that the technology is fake. The con is the price. It's the promise that every one of these companies will win, that the growth will never slow, that you have to buy in now or miss out forever. The best cons are always wrapped around a truth. That's what makes the mark reach for his wallet. And this is where a Nobel Prize winner named Robert Shiller comes in. The economist at Yale who literally wrote the book called Irrational Exuberance, which came out right at the peak of the internet stock craze in the year 2000, just before it crashed. Shiller built a tool that a lot of serious investors still watch today. In plain terms, it measures how expensive the whole stock market is compared to how much money those companies actually earn, smoothed out over years so a single good quarter can't fool you. Think of it like checking whether a house is priced fairly compared to the rent it brings in. When that number gets stretched high above its normal range, it doesn't tell you the exact day of the crash. Nothing does. But it tells you the ground is a long way down. And right now, by that measure, the market is stretched into territory it has only ever reached a couple of times in 100 years. One of those times was 1929. The other was the year 2000. You know how both of those ended. And notice what those 2 dates have in common. Both came right after a stretch of good years so calm and so profitable that doubting the market felt almost stupid. That's the Minsky trap again, showing up on Shiller's chart. The safest feeling moment and the most dangerous moment are the same moment. That's not a coincidence. That's the whole design. So now, finally, that $31 trillion number. What is it really? Here's the honest version. It's an estimate. A figure that's been floating through the reporting to describe roughly how much of the market's value is now tied up in the AI story. Whether the true number is a bit higher or lower, the point is the same, and it's the point that should stop you cold. So much of everyone's money, your retirement account, your index fund, the savings you assume are boringly safe, is now leaning on this one bet. You don't have to have bought a single share of an AI company to be exposed to it. If you own a normal, sensible slice of the whole American stock market, a huge chunk of what you own is now those same handful of AI-linked giants. That's the quiet part. This isn't happening to somebody else, in some casino you never walked into. If you have money in the market, you're already at the table. And in every con ever run, the last people to find out are the ones who never realized they were playing. Now, does this mean AI stocks crash tomorrow and you should panic and sell everything? No. And anyone who tells you they know the exact day is lying or selling you something. Bubbles can stay inflated far longer than seems possible, and plenty of people have gone broke betting against them too early. Even Michael Burry could turn out to be early. But that's not really the lesson. The lesson is older and simpler, and it's the one thing every survivor of every crash says afterward. When the story gets loud enough that everyone believes it and nobody's asking the price anymore. That's not the moment to feel safe. That's the moment to check where the exits are. Because the crowd cheering the loudest is never the crowd that gets out in time. So here's the question worth leaving open, and it's the one that actually protects you. When a bubble finally pops, the money doesn't disappear, it moves. The smart money, the insiders, the people who left early, they don't sit in the wreckage. They already know where they're going to hide, and what they're going to buy for pennies from the panicking crowd on the way down. That's the real move. That's the next video, where the money goes when the music stops, and how ordinary people have quietly gotten rich from other people's crashes. If you want to be standing on the right side of that door when it happens, subscribe and stay close. This channel is for the people who'd rather read the game than be played by it. Because in the end, everybody in that room is shouting about the promise. The revolution. The sure thing. But the promise is what they say. The trade is what they do. And the man who's been right before just quietly bet almost everything that the crowd is wrong. So watch what the money does, not what it says.